This CKNW podcast is brought to you by Destination Toyota in Burnaby, BC's #1 Toyota dealer for the sales purchase experience.
Stephen Todd has been Stock Market Timer of the Year long-term several times. He's also been Gold Market Timer several times. He's been Bond Market Timer. I look forward to chatting with him in just a couple of minutes. But Michael Levy joins me on the line right now. Mike, before the break, we were talking about the Canadian dollar. And I'll just give you one little example. As we've watched out of the events in Egypt seem to push the price of oil up, 103 and change. Usually that has a positive impact on the Canadian dollar, but as you just chronicled, while oil's been going up the last little bit, since the disruptions in Egypt, we've watched the Canadian dollar sag. I always think that's a major warning sign for more weakness to come. We gave it a good excuse to go up, and it didn't take it. In fact, it got weak. It tells me that the prevailing sentiment on the Canadian is down.
Well, Mike, that's true, and I just have to point out that since the Suez Crisis of 1956, there has not been a disruption in the Middle East or Egypt that has stopped gas, or that is LNG, liquefied natural gas, or oil from sailing through the Suez Canal. So, again, this is a bit of a knee-jerk reaction. It's happened before, but certainly hasn't changed the landscape. You're absolutely right. It would have to be somewhat more of a permanent dislocation, like we saw in Europe, like we saw in the United States, where there was no end in immediate sight. And this is why the Canadian dollar, there's been a change in the price of oil, but certainly not a change in sentiment. And I think that this brings us to our last point, is what's going to change to send the Canadian dollar up? There are two things. You alluded to it right before the break. China could be one of them. And the fact that the U.S. landscape or Europe landscape would have to change. We would need another event, Mike, that shook the world before we're going to see this kind of a change.
As I said, going back a while, you were warning about the drop in the Canadian, and you sort of reviewed all what the banks and the institutions were saying, and they were calling for a dollar, somewhere around 90 cents, even as low as 87. Now, do you think that's in play now, that they've seen the market action since in the last several months?
No, and Mike, I have a reason, and it's a fundamental reason, and Lord knows I can be wrong on this one. Things aren't bad in Canada. People are not fleeing Canada because they are afraid of having their money here. They're looking for greater opportunity, but that doesn't mean the door is shut here and there's zero opportunity here. So for the time being, I stick to my 93 to 95 cent forecast. If, in fact, it goes further down, then I'll take a look with a fresh pair of eyes. But right now, I think people tend to overreact to the upside and also overreact to the downside. And I don't take bank economists and single them out as being different than everybody else. So I know they were 90 to 95 cents. Now some of them have brought their forecast down to 87 cents. I stay at 93 to 95 right now.
As you say, we'll watch the market. It'll tell us what's going on. Mike, have a terrific weekend.
You too, Michael.
Stephen Todd, as I just mentioned at the top of the show, has been Timer's Digest Long-Term Timer of the Year several times. He's been the Bond Market Timer several times. He's been the Gold Market Timer several times. Very pleased to welcome back to the show from Todd Market Forecast, Stephen Todd. Stephen, thanks for finding time for us on the weekend, but there's certainly no shortage of things to be chatting about. I don't even know where to start, so maybe I'll start with your perspective on the overall stock market.
Okay. Good morning, Michael. Anyway, I think that the stock market has got several weeks of rally ahead of it for a couple of reasons. People get bearish at bottoms and they get bullish at tops. One of the indications of a bearish sentiment is the CBOE put-call ratio. The 20-day moving average right now is the highest it's been since June of 2012. That was a very significant low in the stock market. The latest reading is 1.04. Whenever it gets above 1.0, we tend to have a multi-week rally. There are several other indicators that are also oversold. The weekly advanced decline 5-week moving average is oversold for the 8th time since August of 2010, and the previous 7 times we had a multi-week rally. So I think we're going to be okay for the next several weeks. I think we will have a decent rally going into there. Going further out, we could, we've been going up for 4.5 years, and frequently after 4.5 to 5 years, you'll see a more significant correction. I don't see that yet, but that's something we need to keep, just to keep our eye on here and just keep in the back of our minds. But I think for the next several weeks to a couple of months, we're going to be in good shape.
Yeah, it is interesting. What are we? I guess we pick a date, but let's go back to March of 2009. You could sort of pin that as the beginning of this bullish move, and we're into it quite a bit, coming into 4.5 years. And I guess that's getting pretty much what I think this is the sixth longest move without a significant drop, a significant correction.
I have not heard that, but it has been relentless, And
yeah.
Ben Bernanke's getting credit for this because he just keeps throwing money into the system. So I wouldn't doubt that. I have not heard that particular statistic.
And it's interesting when you go, and this may sound like a bit of a superficial question, because it probably is, but is this a more difficult market because of the phenomenal intervention of central banks, whether it's, obviously in Japan, we just had, European central banks say, in conjunction with Canadian Mark Carney's now the head of Bank of England, saying, hey, we're going to keep rates low for X amount of time. I mean, just that the prominence of the central banks seemed to be a game changer for the markets, as you just alluded to.
It really isn't a game changer for me because of my methodology. I'm basically a technician. I look at overbought, oversold. I look at sentiment. I place a lot of emphasis on chart patterns. I like to see rising patterns, rising tops and rising bottoms, things like that. Those types of things have not betrayed me. They've been, they are as reliable as they always are. What I hear a lot in the financial media, though, is we have a very poor economy. What's the stock market doing going up?
Yeah.
Now, I can tell you this: the stock market has. I've been in the business for over 35 years, and I can tell you many times in the past the stock market would rally on bad news and go down on good news. The first is called climbing a wall of worry. It's an axiom in the stock market, and going down on good news, that's called going down on the slippery slope of hope. So, we're the market, if it were that easy, the economy's good, the stock market's going to go up, let's all get rich. It doesn't work that way. The market likes to throw you curves. It likes to, it's like walking through the woods at night and you hear all kinds of noises and things like that, and you wonder, hey, should I be out here? So I think that if we look at the right things, we just look at the chart pattern. When you see the market, and this is one of Dennis's nice little comments. If it goes from the bottom left to the top right, stay with it. You're in good shape.
Mm-hmm. Well, this is one of the distinctions that, for people who are not constantly involved in the investment side of things, that's confusing, is that distinction between fundamental analysis, and that's what you were just alluding to, people looking at economic statistics or even company statistics, compared to seeing how the market is interpreting it through price action. And it could be price and volume, and as you say, you've got proprietary measures that have steered you in the right direction over a number of years, and hence your record of topping Timers Digest, bonds, stocks, and gold over different time periods. But it's just that, as you appreciate, Stephen, it's kind of a confusing distinction that but it makes total sense, as you're saying. Let me tell you, I hear all the news out there, but let's just see what the market's saying about the news in terms of price and volume action.
That's exactly right. Just all this stuff is too complicated for me. I'm a simple man. But if I see the market going up, then I interpret that as bullish. If I see it going down, I interpret it as bearish. Right now, it's we had a correction. I think we're going to go back up now. One other point though, just to make the fundamental point here, we've gone up since since March of 2009. We've gone up, let's see, we've gone up about, about 140%, and earnings have gone up about 140% during that time. So from that fundamental viewpoint, it makes perfect sense. This rally makes perfect sense, even though, the economy has not been good for Joe Sixpack. It's not been good for Main Street. It's been fabulous for Wall Street, and that's what we're in business to make money, and so we have to look at that from that angle.
Talking with Stephen Todd, Todd Market Forecast. Stephen just mentioned